Thanks, everybody. Appreciate you joining us. We'll kind of kick it off here. I'm Clayton Whitfield. I'm one of the founders of SaaStock, and for those of you that can't get enough of reading, can't get enough of reading press releases, you've probably seen that SaaStock and Chargeify have merged to become Maxio. Started SaaStock back in 2009, so we've been at this a long time now, which explains the gray whiskers. And now I'll kick it over to Jon.
Hi everyone, I'm Jon. I'm one of the partners at Mountside Ventures. We exist to optimize the fundraising process for both companies and for investors. We set up about 3.5 years ago, and we've helped companies to date raise over 100 million in institutional funding. And thanks for coming along. Back to you.
Awesome. So we're going to talk, it's kind of two phases in our presentation today. The first is going to be sort of the state of the B2B SaaS subscription market, and then we're going to talk about how that has affected and maybe changed some of the metrics that investors and founders and LPs need to be focusing on. So one of the things we'll be pointing to a fair amount here is the Maxio Institute has done a growth index report, so a lot of the data and the trends in graphs you'll be seeing here come directly from that report. I'm not going to get into the methodology of the report right now because we are limited on time. But if anybody wants to geek out with me about the methodology, please come and meet us at our booth. We're in booth G1. We can get into the methodology behind these data. And only one warning there: if you get me started talking about regression analysis and stuff like that, you're just going to have to walk away because I won't stop. And then you'll have only yourself to blame. So you can see here we've got a few things. I'm not going to read this to you, but the big takeaway here is valuations have gone down significantly since 2021. In 2021, it wasn't uncommon to see 20x multiples, and then 2022, 10x multiples. In 2023, we're looking at mostly 5x multiples. These are averages, obviously, but it's across more than 1,000 private companies. So a huge data sample set here, and valuations have clearly declined quite a bit. 75% decline, as you can see, from 2021. And Jon, you want to jump in on that? Anything to add there? Is that consistent with what you guys are seeing?
Yeah, it's consistent. I'd say what's interesting and what's probably propping up multiples even more than we're currently seeing is a lot of companies are at the moment doing inside rounds. They're doing convertibles and they're doing kind of non-priced rounds. So if anything, the 5x that the index is currently showing could be an inflation to what we see going forward. I'm personally a bit more bullish about how valuations will kind of grow, hopefully, over 2024. But there are definitely factors that could drive that 5x multiple down even further than we're already seeing.
Right. Thanks. So you can see here we've got public and private valuations, and they're declining because of declining growth. You can see the blue line there is public companies. The red line is the Maxio benchmark. And you can see with slowing growth comes compressed valuations, as you can see there. The other thing, too, that is hopeful that Jon just mentioned is if you look at the red line, it looks like it might be getting a little bit of a rebound here and possibly headed the other way. We'll talk more about that as we go. So you can see some growth rates here this is Q1 of 22 to Q2 of 23. And you can see the growth rates began decreasing in Q3 of 22, and then that really accelerated in Q1 of 23. And the big thing that is weighing on, creating a sort of anchor on these rates is companies that are under $1 million of ARR. Their growth rates are declining faster, and they're weighing on the overall averages of the growth rates. You can see here the blue line includes 1 million companies that are under $1 million in revenue, under $1 million ARR, and the red line excludes those. So which makes perfect sense. Companies that are still maybe looking for product market fit, hence under $1 million of ARR, are very likely to suffer a little bit more in a softer market. And one of the things that we've run into lately with our conversations with investors is many of them will say that if you're 2 million or below an ARR, then you haven't found product market fit yet. That's just they see it very simply like that. So that's obviously a generalization. It's a bit reductionist, but that's kind of what we do as humans, right? We create heuristics for ourselves to say this equals that. And some of the investors we speak to say, if you're 2 million or less, you haven't found product market fit yet. And can you?
Yeah, and I'd say over the last few years, companies we've worked with were raising institutional funding, Series A on like $500,000, 800K ARR levels. In the current environment, that kind of magical 1 million ARR you need to go into a Series A, to be honest, is probably more like 1.5 at the moment. So there's 50% additional requirement. And so that's really affected, I guess, the investment processes for companies who previously were gearing up for a Series A, and now the goalposts have kind of shifted. And obviously, when you're gearing up to get to that 1 million ARR to raise your Series A, you've raised kind of the capital you needed to get there. And now a lot of companies are finding that they haven't raised enough to be able to go into and run a competitive funding round with the capital raised today, which again is leading to more inside rounds, more kind of debt rounds to kind of extend runway to be able to kind of get to those additional goalposts that they need to get to be able to run a competitive process for their A round.
Awesome. We'll talk a little bit more about that later when it comes to sort of the keys to if you're going to go out for funding soon. We'll get into some of the product market fit stuff later. Thanks, John. And again, here, if you take a look at the trend lines here, it looks like we might be starting to see a little bit of a rebound, and that's obviously let's all hope, right? That would be a beautiful thing if that could be true. So we can. Oh, this is growth rates by company size. So this is ARR here: 0 million, 1 to 2, 2 to 6, 6 to 10, and so on. And you can see the years are broken out in different colored bars here. Our 2023 Q2 of 2023 is the pink bar. You can see as we just discussed in the previous slide, the 1 million and less are really sort of weighing down the growth rates. And 2 to 6 is actually seeing the least amount of impact according to our data, and 20 to 50 is experiencing a material decrease. And I don't have any causal data on that, but I do have a suspicion, and I'm wondering if John will back me up on this or shoot me down. We'll see. One of the things that I suspect, one of the reasons that we see in the 20 to 50 some struggle there is the things you've been executing to get to 50 million are often not the same things that you need to do to execute to get on the other side of 50 million. And so there's an inflection point there for many companies, and you tend to be in a good environment when you're not worried about, when not a very soft market, you can kind of just focus on what you need to do to springboard beyond 50. But in an environment like this, you have to kind of do that and continue the sales and continue making changes in sales and marketing, go to market, and all that kind of stuff. So you end up kind of with a bunch of moving parts and trying to pick which one wins. I'm curious if you.
Well, I was going to comment on the 0 to 1 million level.
Yes, please.
I predominantly work with B2B companies, and at the 0 to 1 million level, when you're selling enterprise and when you're selling to larger organizations, again, goalposts have shifted. Larger organizations are expecting you to have stronger balance sheets. They're tired of kind of their vendors kind of going under and having to redo processes, and they've got much longer sales cycles. And so if you're at this 0 to 1 million level, you need to raise funding to kind of bolster your balance sheet to go into those enterprise conversations, but then it's very hard to get the funding to go into it. So it's created the valley of death before Series A, from seed to Series A, has got even deeper. And so that's something that I'm fairly concerned about over the next year, that a lot of these seed stage companies aren't going to kind of get to the level to Series A, which is then going to negatively affect the larger enterprises, because there will be more moving towards kind of bigger legacy software providers and maybe not the best service that they could have, as a way of kind of going at it from a safety approach rather than taking a bet with an innovative smaller company.
Yeah. So again, hopefully this is looking like we're starting to stabilize. 50 million above is looking like we're stabilizing a bit in Q2 of 23, and hopefully that's the trend that continues for us. This is a quarterly growth rates by. This is obviously very correlated to what we just saw on the previous slide. Revenue bands and the rounds that these companies have raised. So you can see here that Series B is looking pretty strong relative to the others, but there's still some growth expectations. Hopefully John will give us some of that in a second. But even so, there's still some growth expectations. Many companies are still expected to triple, double, the T2, D3 thing. So there's still some growth expectations out there from investors. And some companies are still managing to accomplish that. It's hard work, but they're still getting it done. And the winners are still getting capital. So the ones that are still doing that are still able to raise funds.
Yeah, and a lot of investors are sitting on a lot of capital that they should be invested. There's a lot of dry powder out there. Yeah. To be honest, if you are I mean, average growth rates at the moment are more like 50%, down from kind of like, for European companies, 80% average last year. For American companies, 100% average last year. Both of those have declined, a smaller decline in Europe, but obviously from a lower base from the prior year. And so if the kind of median average SaaS company is growing by 50% and investors are expecting 100% growth, this is why we're seeing a massive slowdown in deals. And so I guess the expectation that companies follow the triple, double, double, double pathway is incredibly hard at the moment, like, especially when there's such a focus on capital efficiency as well. And this is kind of comes into, and this is kind of contradictory to, I guess, the Bessemer Index. When we think about the Rule of 40, the Rule of 40 is about sustainable growth. And previously, the lens of the contribution to Rule of 40 was about 6-to-1 ratio for growth versus profitability. Over the kind of 2023, that ratio has come down to more like 2-to-1. And so there's a much bigger lens on profitability from investors and the contribution to those kind of efficiency metrics than there used to be. But there still is that kind of over-expectation on growth. And so where should founders be putting their time? They're kind of being pulled in two separate directions. One in the, I need to get to 100% growth, but the other in the, oh, but you burned £1 million to get to the million. It's like, it's very hard place to navigate. And over the last few years, I definitely saw investor opinions kind of converge. And over the last 12 to 18 months, they've diverged again. Investors who previously had very similar theses and very similar ways of thinking about companies now take very wildly different views. And so for a founder who's trying to put together their investment proposition, it's very hard to create an investment proposition that appeals to a critical mass of investors in the market. And so now founders are very confused, and they're like, oh, do I create a different plan for this investor and a different plan for that investor? And that's something that wasn't really happening a couple of years ago. And now I'm seeing companies run 3 different financial models for the 3 different types of investors with 3 separate diligence documents. And that obviously means that management are spending 3 times the amount of time on diligence and even less time on their clients and trying to get the growth. And so having a broad set of, such a broad set of expectations by investors has made navigating the fundraising landscape, which was already very opaque, like even more opaque than it was. And so I'm hoping over 2024 that convergence starts happening again, because it will save founders huge amounts of time in the mission to get funding.
Yes, right on. Oh, here we go, Mountside.
So I thought I'd just kind of show this diagram on the right. Everyone here is probably mainly founders, mainly startups. So kind of at the bottom, you have the startups. What you need to understand is that most VC investors, with very, very few exceptions, do fundraise themselves. And so the reason why there's been such a slowdown in deal volume and deal value is because the VCs themselves are really struggling to raise capital from limited partners. Limited partners are people like corporates, endowment funds, high net worth, family offices, and government organizations. I guess for us, we are not a direct investor. My day-to-day job is I essentially act as an interim fractional CFO for Series A and Series B companies looking to raise institutional funding. And as per our last deal, in the last 3 years, we've now raised over 100 million for the clients we've worked with. We also run a investment readiness workshop for underrepresented founders. So any founders who are based in or around London, female founders, basically a founder who does not look like me. We run completely free educational courses to help you access private capital. But if you can understand how LPs behave and what they're doing, you can really empathize and sympathize with investors. Because VCs are struggling to raise capital, they're investing at much lower valuations. A couple of years ago, I virtually worked on 0 venture debt engagements. Now, years to date, we've closed about 20 million of venture debt across our clients because the cost of equity has become so high. So when you're thinking about running a fundraising process, really understand that VCs are the tip of the iceberg when it comes to funding. They aren't the be-all and end-all. And they've done a very good job of kind of, with their marketing teams, making it seem like they're the holy grail of funding. But many companies can grow well with things like venture debt funding, if you are trying to follow an organic, profitable pathway, revenue-based funding. You've seen like the likes of CapChase and Uncapped doing small loans to kind of support growth. And one thing I've seen that's chronically underutilized is grants. The UK has joined Horizon grant program. Like, there is a huge amount of grants, and every founder should be tracking and applying for every grant, because they're completely non-dilutive. It's essentially free money. And there's a huge number of grants out there that, again, are not being utilized well enough by founders. So this chart was basically, this slide is basically to show you that there are so many fundraising options out there that isn't VC, and those should all be explored to see if they're right for your business. However, there are lots of new VCs in Europe. Here's a kind of just selection of VCs, and what's quite exciting as well, we have La Famiglia. They raised a new fund this year. They were just acquired by General Capitalist, which is one of the biggest US funds. So it shows that US investors are really kind of focusing in on the European tech scene, because VCs buying other VCs is incredibly rare. I barely ever hear of it. And so having General Capitalist buy La Famiglia and merge with them to get more access to European companies is probably a very good tick box that, like, US investors hopefully will become more active in Europe over time. So what has changed in the current market? This is all personal experience. We've closed about 30 million of institutional funding for our clients year to date, and the first thing I would say is that we used to budget for a 3 to 4 month fundraising process, and that was pretty mechanical. That would go on. Now, for the exact same process, we're seeing 5 to 6 months. I think one of the main reasons for that is, for an investor, time is the best due diligence an investor can do. If you're going to a funding round saying, here's my pipeline, here's what's going to close, previously you could close the round before really seeing, does that pipeline evolve? Now, 5 to 6 months is what I'm seeing. Investors are asking for evidence and diligencing virtually every metric in the value proposition, when previously they were focusing on a few key ones. Really do make backup plans, assuming the fundraising will take longer than expected. As we mentioned earlier, VCs are really focusing on profitability more than growth. But if you're going into a funding round without 50% ARR growth, that is an easy way to be filtered out. And so really think about the focus on profitability while also making sure you're hitting kind of that at least 50%.
One thing I'd add on number one there, the longer due diligence process. One thing we hear a lot lately from both investors and prospects is a couple of mistakes. For any of you that are going out for capital, a couple of mistakes that are easy to avoid, but that people consistently make, and I hear it enough to make me think it happens with some regularity, is counting non-recurring revenue as recurring revenue. So effectively overstating your recurring revenue. The other one we hear a lot of is your gross margins are too high. Effectively, what that means is you're not including enough cost in your gross margins. So you're overstating your gross margins and you're overstating your revenues, or either or is a problem. And what's going to happen if especially if the investors discover that, your potential investors discover that, they're going to slam on the brakes in due diligence and slow everything down and make it and exacerbate that timeline that Jon just mentioned. And the other thing too, there are two outcomes that really come with that. One is it makes you look a little bit amateurish. If you're overstating your gross margins or overstating your revenues, it makes you look a little bit amateurish. That's not great look, but even worse is it might make it look like, hey, are these guys trying to pull a fast one? Are they trying to trick us? Luckily, that doesn't happen too much, but it does happen sometimes, and it injects a little bit of mistrust into the relationship unnecessarily. Investment is such a relationship business. I'm sure Jon would agree. It's such a relationship business, and if you inject a little bit of mistrust in there unnecessarily, it can wreck everything up. So back to you.
For sure, and I guess I wanted to speak a bit more about kind of the metrics that really do matter, right? That's why we're here. Yeah. A lot of these are obvious, but the one to really focus in on going forwards is your burn multiple. Burn multiple previously wasn't really that kind of utilized, but the burn multiple of net burn over net new ARR is essentially the capital efficiency that investors want to see. So they want to understand how much cash are you burning to how much ARR you're generating. Net dollar retention is another big one, and that all feeds into your capital efficiency ratio. Basically, the outcome from this is investors want to see founders stay at the grind. They want to founders who previously could hire in a salesperson, step away from sales, and kind of move more into that CEO role. To have high capital efficiency, you need to be running that CEO role while still being the head of sales. And that's not a nice message to hear. That's going to cause a lot more sleepless nights. But if you want to go down the VC track, that is definitely an expectation that investors have, because that's the only way to keep your capital efficiency up. Logo retention is now much more important than new logos. Net dollar retention is much more important than kind of ARR growth. And so looking after your existing customers, investing more into customer success rather than bringing in salespeople is a way of really weathering that storm and showing that you are, and if you are able to kind of keep your customers and upsell, it really puts you into that must-have bucket, not the nice-to-have bucket. If you have customers that churn, firstly, it puts you in the nice-to-have bucket, and secondly, if you're going through a diligence period and one of your customers churn that you're not aware of, and you haven't preempted that conversation, that kills deals. And we've worked on a deal recently that was killed by a client churning that the founder wasn't expecting. Yeah. I'm probably not going to chat about the metrics that matter to LPs investing into VCs. We're running out of time. But I did want to give you one stat. So we've just launched the first ever fund-of-fund report for Europe. Fund of funds are LPs that invest into VC funds. And just to make all the founders in the crowd happy, we surveyed 104 fund of funds with 35 billion in AUM. They see 14,102 decks per year, and they only invest into 744 VCs. So when you send out your deck to 100 VCs and you only get a couple of meetings, just realize that the VCs who are doing that to you, the LPs are also doing that to them. If anyone wants a copy of this report, please do go on our website. It's a completely free resource if you want to understand of these 144, how they think about investing into the VC funds, which ultimately invest into you.
Awesome. So last bit here, as we said earlier, got to have product market fit, disciplined growth, growth efficiency. You got to have disciplined growth to weather the downturn. And again, just like Jon just said, retaining customers is key. Customers are your golden goose. You can't be losing them for no good reason. I guess I mentioned all this data, all the data we started with, and it came from our Maxio Institute research report. So feel free to swing by our booth and grab it. It's absolutely gorgeous. Check it out. So feel free to swing by our booth. It's G1 over at the end there, and grab your own copy of it. And, oh, I just said that. Never mind. So,
Thank you.
Yeah, thanks, guys.